Hello, everyone. It's Doug Rogers, December 29th.
This is Russell Rogers. We're the Rogers team with Keller Williams Southlake. Let's talk DFW real estate. So, Doug, we're at the end of the year. So, let's do a year end recap and kind of look at the numbers and see what this year looked like. What do you got for us?
Okay. Well, here's kind of the good news first. We've become a normal market in a lot of ways. The Grapevine, Colleyville, Southlake, Keller Market, Alliance, Flower Mount, Capel, Plano, Frisco, all of those markets are selling at 98% of list price. They're taking on the average between 32 and 37 days to sell. That's back to normal. That's the way it's supposed to be. That's actually above average for what I've experienced over the last 35 years. So far as what we sold on an average price and a median price on a year over year kind of basis, you have to put into context first that let's take Grapevine, Colleyville, Southlake, Keller. We sold 10% fewer listings. That means we are down about 180 units year over year. So sometimes when you're down in units, your average sales price goes up. So our average sales price was at 972,000, which is 26,000 higher than year over year. The median was at 755, which is 20,000 higher year over year. But something that's real important is the last 90 days is completely different than the rest of the year. The rest of the year is much higher than the last 90 days. We're still down another 8 or 9% compared to those numbers if you look at year over year. The Alliance corridor is actually down on average. They sold 11% fewer units. Sales price at 401,000, 16,000 lower than last year. The median was down 16,000 year over year, and the last 90 days is down another 10%, not 10%, but another 12, 15,000 over that number. Flower Mound, Capel, Highland Village was up 14,000 year over year. Their average was at 716, median 625. They sold 13% fewer units, and over the last 90 days, they're actually doing pretty well. On Frisco, Plano, their average is up 15,000 year over year. They're averaging in that marketplace 712. Their median's at 605. Last 90 days is really pretty good, 697, and their median is a little lower at 590. But they did sell quite a bit fewer units. They were down 23% in the number of units they sold year over year. So prices are still holding okay. They're dropping a little bit, but I still have this theory that because of our interest rate drop, we're going to see prices eke up a little bit, and days on the market might actually go down a little bit. So I've got some optimism that these numbers will change over the next 30 to 60 days, but we'll have to wait and see. But overall, it was a pretty good year.
Yeah, it's interesting. If you just ask somebody off the street what they thought about those numbers, or if I had to guess, I would have thought the number of listings sold was going to be way down from that 10% kind of area, and that the asking price would be lower, or the sales price would be lower than the 98%, and that the days on market would be higher. So it is kind of interesting when you add the year together, not having any seasonality or any of the issues with interest rates, that those were the numbers. So that's kind of interesting to know on the back end.
Well, I still think you're right on a point there. When you say something's down 10% year over year, well, we have to go the year before as well. They were down another. The number of units sold last year in 2022 was low. So we went from a low year to a lower year to a lower year, and each year we've stepped down and we're selling fewer units. So that actually bolsters sales prices and keeps them probably inflated just a little bit. But it would be interesting to see if there's some pent-up demand with the interest rates. And then from an interest rate perspective, if I were to ask you what was the interest rate this time last year, what was it?
Yeah,
Most people are going to guess something high.
Yeah, I thought it was maybe in the fives and we went higher, but I think the average person would think something higher because they've been high this year, and of course people get quotes. They're often not the lowest rates. So, I actually thought we were lower, but yeah, to your point, we started the year off at 6.4% on the 30-year, and right now we're like at 6.67 for the national average. So, that's not that much higher. Of course, we've just come down like almost a point and a half, basically, in the matter of like a month here, or a little bit over. But yeah, we kind of went up and back down, but we're kind of back to where we started from last year.
Yeah. Well, sales prices seem to have a lagging effect in the real estate industry. So when I look at these numbers that took place over the last 90 days, they really were impacted because of August, September, October. That's when those homes sold, and then they get recorded in November, December as sales. And so I have a feeling that the last 90 days may be more pessimistic in their actual reality, because if you take the next 90 days with the new rate going from 7 something to 6 something, and number of units actually being pretty low. Because that's one other point of this story is the number of houses on the market right now, like in Grapevine, Colleyville, Southlake, the actual number of listings only 216. When we started tracking this in August, that number was at 304. The Alliance Corridor right now is 359 active listings, where in August it was 399. Flower Mound, Capel, Highland Village is at 169, which is really low. And when we started tracking, it was 202. Then the Flower Mound, I'm sorry, the Plano Frisco market, when we started tracking, it was 692, and now it's down to 464. That's 23% lower than when we started tracking this, just earlier this year. If you combine a new interest rate and a small number of listings that we're going to see in January, if it's still low in January, that could be a good month to be a seller.
Let's talk about what next year might look like too. Of course, this is all
Theory.
This isn't anything I would advise someone on, but some different basically probabilities of outcomes that might happen. And I think one of the more probable, although I'm not saying the most probable or more than 50%, but a very high probable situation is just that, where we have more listings come on, but still lower than traditional or lower than historical. And the anticipation of rate cuts keeps interest rates kind of where they're at or lower, or kind of, basically below 7. And the pent up demand from the last several years from buyers not wanting to buy under higher prices and higher interest rates and lower taxes in this area could compel these prices quite a bit higher from here and really set a floor in what people might think is like some kind of a downturn in housing prices.
I agree. I think we've got a couple other things with the anticipated rate hike I guess it's coming in March, theoretically. The Fed, I guess the marketplace is anticipating 6 rate cuts. So if we actually get 2 or 3 of those in the first quarter and the second quarter, where will interest rates go for mortgages? Can we see 5.78?
I think buyers would be much happier with like a 5.5, 5.75 kind of for all purchasing needs, whether they're upsizing or first-time home buyers or whatever the case is, especially if they've had any built-in equity, and then they see those lower interest rates at least getting closer to what they have now, right? Where I have a 2.75, so 8 seems crazy to me, but maybe 5.5 doesn't sound quite as bad. And so, yeah, I think if those rate cuts do occur, because it is projected 3 times by the Fed and then 6 times by the market. So I imagine it'll be in between the two. But the point of the matter is it's now fully anticipated or fully projected, because the Fed had been saying higher for longer for so long and never really admitted about any future rate cuts, because I think that was kind of a wait and see, where now they're actually projecting it. So it's fully on the table at this point. So yeah, I think we see higher prices next year, or at least there's a high probability that we do.
Well, I also think another thing's going to happen that's going to impact sales on the upper end, because when they have the next rate cut, there's going to be an overreaction in the stock market, and there's going to be money piling in saying good times are here again. And when the stock market goes up, big houses sell. The 800 to 2 million price point is just going to do really well.
Yeah, and I think we're going to return to probably some competitive offers coming in terms of competing for the house. So I think we're going to see multiple offer situations again, where now it's almost like most are not getting that, except in those high trafficked areas like we've talked about. But I think even in Alliance or others up and down the chain, we're going to see more competition for houses, even if more listings come on the market, because I don't know if it's going to be so much that it drowns out all the buyer demand. Well,
I think there's pent-up demand. I think there's a ton of people out there kind of waiting on the shelf, hoping for the rate to drop, and they're doing the math. If they're struggling financially, it's one thing, but if they're the guy who sold their house in California and had been in an apartment complex in Grapevine waiting for the right size, right price point, the right location to come along, I think that's the buyer that you want to snag, because they're ready to buy a house. And if they've got a big equity, it's sure easier to swallow a 6% interest rate when you're putting 30, 40, or 50% down.
I was looking at that the other day, where for my house with the 2.75% interest, I forgot it was that low. The principal payment was like huge for only having a few years on that note, because I refinanced during COVID. And it's like the majority of the note, it's like $200, $300 in interest, which is normally the opposite. So I was kind of like confused on the math. Like it's going to take forever to pay off the interest at that amount, but it's only because it's very small, but it's only because of the interest rate. It's just so opposite what we're used to. And I don't think many people coming into the market are really going to have that mentality because it's such a weird concept to have that low of rates. So unless you have it, you're first time home buyer, or you need to move, or you got a bigger family, like I don't think it's as impactful as we think it's going to be as we go the other direction, meaning interest rates go lower and the payments get lower, or to your point, the market goes up, the stock market goes up, people's net worths go up, and those higher salaried individuals continue to buy anyway.
Well, higher salary people, the rich folks, I call them, is they never ask me what the payment's going to be. They don't say, will you calculate this for me? What's the monthly payment? They don't ask that. They just ask how much and what can we negotiate to on this sales price. They really are more concerned about their net worth so far as their 401k and their investments, and that's what they're concerned about. They actually probably profit to some degree from rising interest rates under certain circumstances. But young people who are buying their house for the first time always want me to calculate to the penny how much down and how much a month. And we do our best to get that exactly right.
Yeah, so we could actually have several compounding factors making both groups want to buy this year.
That's true. So it could be an optimistic year, but it's all about the change in direction of the rates. And the Fed has actually said we're going to go the other direction. And so now people are optimistic and they're watching it. And if, let's just say someone who never really thought about buying a house until earlier this year, and summertime comes along and they're looking at 7 3/4, and then they're looking at 8. 5 7/8 or 6 1/4 is going to look like it's on sale.
Yeah, I mean, it's several $1,000s a year, I think. I mean, I've done the calculation. There's other things that would depend on, but it could be several $1,000s a year in interest, and so that's several $100s a month. So yeah, instead of $1,800, it's $2,100, and that can make a big difference in someone that doesn't have a lot to cover that.
Sure, $200 or $300 a month. That's a lot of money to some folks.
Yeah, especially when you're renting something and there's already a skew that renting is cheaper, because that has been the case in a lot of places lately with housing prices going up so much. So not only is it more expensive to buy, but now it's like extra even more expensive to buy with those interest rates. So yeah, if that eases up, we could see buyers that were on the shelf coming back in.
Well, I think rents have been going up quite a bit. I've got several friends that are in apartments right now off of Main Street, and they're in the high-end kind of apartments. And one young man works for Fidelity, and I talk to him all the time, and he's just amazed at how much he's paying in rent. It's gone from $1,200 to over $2,000, and he hasn't moved apartment to apartment. He's in the same unit, and he's been there less than 10 years, and he's almost $1,000 more than when he started.
I think a lot of those areas like Grapevine and stuff, they don't have enough housing anyway, so it's hard to imagine those really going down. And same thing for houses, right? Like there's not many more places to build, so that kind of spreads out the population. But yeah, it's been kind of similar in a lot of places where they've built a lot of apartments, like in Alliance, that have helped keep apartment prices low, but they're still extremely high compared to what they were 3 years ago. And so I think that helps on the rental market side, but more importantly, people getting out of apartments, because the substitute product of a house or a rental house is much better for the value.
Mm-hmm. Yep. So what do you think so far as the rates in the next 90 days?
It's either going to be one cut in March, because that's what everyone thinks. And usually there seems to be a skew to when everyone thinks something, it happens. I don't know if I want to say that is all back alley handshakes or not, but it does seem that when the whole market thinks one thing, it usually does occur. So if I had to bet on it, I would bet for one rate cut in March, and then they'll see through the year what that looks like. But what do you think is going to happen?
I think because it's an election year, there'll be a rate cut in March, unless something really incredibly spikes in inflation in the next 3 or 4 reports, or if unemployment starts to drop. Unemployment going up a notch or two will actually make the rate cut more automatic. Mm-hmm. But if we see some sort of spike, and I don't know if you saw today, the price of oil was tanking. It was tanking hard. It had a reverse trend, and it's trading much lower. So with oil going down, inflation holds steady, we're going to see a rate cut in March.
Yeah, because of the economy's getting worse, is your point there, right?
Yep.
Yeah. And yeah, the politics of it all, the CR was only passed through January, or I don't even know the date, but sometime in January. I don't know if the two parties will fight about the final dollar amount. I know there's some concerns about immigration policy and different things, so I don't know what they're all going to decide on. But if I had to bet on that, I would bet they don't cut the budget very much, meaning there's still going to be a very large federal budget for this year, or the continuation through September, which again is going to support housing prices because of the, it's spurring the economy and being such a large part at this point. So, it sounds like we would both bet on higher prices for the next 90 days.
Yeah, I agree. So I'm optimistic. I think it's going to be a good year.
I think so too. And I think it'll lead to a lot of things because there's so much, we haven't talked about it much on here, but there's so many jobs that are impacted by the housing market. I know people joke and say, like, I think Putin said the American economy is built on people selling houses to each other, but I think he's wrong in a lot of ways on that, obviously, but some truth to it because you have home inspectors, you have title companies, there's attorneys in a lot of states that get involved, there's the realtors, there's people's homes, building equity, there's the lenders, there's just so many pieces of it. Home Depot gets spurred when people buy a house.
Home Depot, Lowe's, Weyerhaeuser sells lumber, Toll Brothers, D.R. Horton, the builders. You can track the optimism of the stock market looking at home builders when by their pricing of the analyst, and then just Home Depot and I guess Whirlpool you could even throw in there. People when they buy a new house, they want a washer and dryer and a new dishwasher or a new refrigerator. You could actually look at Briggs and Stratton to see how many lawnmowers are getting sold. So all of those things you can track in the stock market, and all of them are trending high. I looked at D.R. Horton and Toll Brothers thinking maybe I could get in on those before they go too high. And I said, darn it, I think I've missed. But I also have this theory, it's Christmas rally, and maybe in mid-January it'll be a time to buy back into Home Depot, Lowe's, and Toll Brothers and D.R. Horton.
Yeah, so we'll see on all that, but it's such a good thing for the economy, and if it's spurred on by congressional bill making, then I think they're likely to get it done. Maybe not for that reason, but for other reasons.
Well, it's an election year, so whatever they got to do to all get reelected, there'll be a plan in there somewhere.
Exactly, and I think there's a lot of negative connotations to either side holding out on passing that bill. But
yeah, they'll walk it through. It's funny they'll come right down to the last minute and they'll threaten to close a park and not go to a cemetery or something, but they'll get it done. They always do. It's more just politicking. I'm not worried about it as much as I am about the actual inflation holding steady and going in the right direction, because it feels like it's going in the right direction. You can look at the gas pump right now and it's back to 264. I actually saw 249 the other day. So whenever Biden entered office in Texas, then gas prices were at $1.89 to $1.99. So we're 23 to 25 cents away from being at a lower number.
Well, let me touch on one thing before we go today. I have been seeing a few things and want to get your take. So on the Real Estate Mastermind Facebook page, I've been seeing a few things, and this isn't to bully anyone, but just something that I think as a public service everybody needs to know about. But there's been a lot of chatter about several different topics, but most of them being the core component being realtors being out of money. So just something for people to think about. But basically it's been about people not having dues that are due on the first, the NAR dues. We got to pay our dues every year to the National Association, not having the money to pay dues and remain a realtor, or taking second jobs as DoorDash people or jobs like that, waiters and things, or even asking about payday loans to make their ends meet until their next closing. So just wanted to kind of talk to you about that and what you've seen in the past with different economic issues and what realtors have kind of thought about it.
Well, it's funny. I played golf with some guys this week, and they said, "Oh, you guys are doing great. The real estate market must be doing great." And I said, "Well, it's doing great for guys who've been around a while, and it's doing great for people that own real estate. Because if you own a house, and the last 5 years we've just doubled. We've had so much value added to our net worth because of the increases in value. But if you're a young realtor and you've only been in the market 3 years, and you really don't have a big bank account, it can be trying because, we keep talking about it. If you go back to the beginning of our conversation, well, we sold 20% fewer homes in this marketplace, or 18%. That means there's 18 to 20% fewer paychecks in that marketplace for realtors. And that market was down the year before and the year before. So in reality, when you count the number of realtors we normally have, we're probably at a point where we have 40% fewer paychecks going out to realtors who sold a transaction, because the cream still rises to the top, and the young and the inexperienced and the new people, they have a tougher time getting started, because if you really think about it, when you started, you didn't sell a house to a millionaire. You sold a house to somebody who's your own age, who just got out of the military, who just got out of college, because young people tend to sell houses to other young people, and we sell houses to people in our peer groups. And it's the old rule of thumb used to be you always need 6 months of expenses in the bank account to make sure if you're going to be a realtor, the first guy I ever talked to about being a real estate, he wanted me to have a year's worth of paychecks in the bank, and it is a tough situation because I feel for these young people that are getting started, and they get in the business, and then things get really slow. But from a buyer or seller's perspective, I guess the cautionary tale is: are they objective or subjective? An objective is we got the number right. We know what it should sell for. We know whether you should pay for that repair or they should pay for that repair. And we're going to tell you the truth as to what the bottom line is and who should do what. Where if someone's broke and they're in financial trouble, their objectivity goes right out the window, and they say, well, yeah, maybe you should pay over list price, or maybe you should negotiate down. You should take their offer. Well, maybe that's the case, or maybe it's not, but I would sure want to know ahead of time how sturdy my representation is.
And that's the scary thing. And yeah, to your point, it's not to kick anyone while they're down or anything, but I would be very worried if my representation, everything in their life financially depended on me closing. Because what if something happens at the last minute and there's something up with the closing, whether it's on the seller or some kind of crazy event with the house, to your point, they're not going to be objective because they're going to lose their house if we don't close. So in my accounting degree in the audit classes, they always the whole theory of the audit side was just assume everyone's trying to cheat and close all the loopholes and create controls so that people can't cheat. And to me, that is a huge loophole or huge problem, that if you're just using someone because they're your friend or something like that, and they're not a high functioning professional and they have this conflict of interest, just the trouble you could get yourself into in terms of the deal getting pushed for no reason. And we've talked about on the show before, there's been times when I've talked clients out of continuing on because it wasn't in their best interest. So I can't imagine someone staring down the barrel of basically bankruptcy making that same choice. And it was always in the accounting class, it was always, don't think about them as a person, just think about them. It's always, don't judge a book by its cover, but it's the opposite. It's like, everyone cheats, everyone lies, there's no exception, we don't care who it is, and then create the system for that. And so if you don't do it here, you could really get yourself in trouble.
I agree. So always, Ronald Reagan used to say, trust everyone, but let's cut the cards.
Yeah.
Just make sure we're on top of things. But hopefully as the market heals up, these young people do better and they'll have a better shot at making a living. But if you want to do business with somebody that's got a little more experience and it's pretty sturdy, we're always on top of things and we're a step ahead of the crowd, you might want to consider using us.
Yep. So we'll end on that note. I still think the future's optimistic, so not to go too dark on that last segment, but thanks for watching and we'll see you next time. Yeah.